In 2008, while millions of Americans were losing their homes, the United States government created $700 billion out of essentially nothing and handed it to the banks. Not loans to struggling families, not emergency income for people who had just watched their net worth evaporate. The money went to the institutions, the ones who had caused the problem. And most people were angry, understandably. But anger missed the deeper question, the question that nobody on television was really asking. Not where did the money go, but why did the money go there first? Because that is the actual story. Not the bailout, the order. Who gets new money first? Who gets it second? Who gets it last? And what happens to everyone depending on where they sit in that line? That story has a name. Most people have never heard it, and it explains more about wealth inequality, asset prices, and why some people seem to get richer during every crisis while everyone else falls behind than almost any other concept in modern economics. It is called the Cantillon effect. And once you see it, you cannot unsee it.
Richard Cantillon was one of the first people to seriously study what happens when new money enters an economy. Not just how much money exists, but where it enters. And he noticed something that seems obvious once you hear it, but that almost nobody thinks about in practice. New money does not spread evenly. It moves through the economy like a wave. And the people closest to the source of that wave benefit the most before prices adjust, before inflation catches up, before the rest of the economy knows anything new has happened. The people furthest from the source, the ones at the end of the line, only see the money after it has already done its work for everyone else. By the time it reaches them, prices have risen. The purchasing power has been diluted. They got the money, but they got the watered-down version. Cantillon described this in the context of gold discoveries in the 18th century. When new gold was found, the miners spent it first. Local merchants near the mines benefited next. Gradually, the wealth rippled outward, but by the time it reached the agricultural worker in a distant province, bread cost more and his wages had not moved. The money arrived, but it arrived last. And last in this system means poor.
Now, fast forward 300 years. Change gold for dollars. Change mines for central banks. And the structure is identical. When the Federal Reserve creates new money, it does not drop it from helicopters, despite what the phrase helicopter money suggests. It enters the economy through a specific, narrow channel. Government bond purchases, primarily, which means the money flows first to the institutions that hold those bonds. Large banks, primary dealers, financial institutions. Those institutions now have more money. What do they do with it? They invest it into assets, stocks, real estate, private equity, corporate bonds. Asset prices rise. The people who own assets get wealthier, not because their businesses became more productive, not because they made better decisions, but because new money arrived at their door before it arrived at yours. This is not speculation. This is mechanics. Between 2008 and 2008, the Federal Reserve's balance sheet expanded from roughly $900 billion to $4.5 trillion, 5 times larger. And during that same period, U.S. stock markets roughly quadrupled. The top 10% of Americans, who own approximately 89% of all stocks, captured the overwhelming majority of that gain. The bottom 50% of Americans, who own almost no financial assets, saw their wealth grow modestly, if at all in real terms. Same economy, same money creation, radically different outcomes, depending entirely on where you stood in line. Here is where it gets uncomfortable. Because this is not a story about greed or corruption, though there is plenty of both available if you want them. This is a story about structure, about a system that produces these outcomes automatically, regardless of anyone's intentions, because of the order in which money moves. Think about what an asset actually is. An asset is a claim on future value. A stock is a claim on a company's future earnings. Real estate is a claim on future rent or future resale value. A bond is a claim on future interest payments. When new money floods into the financial system and institutions start buying assets, they are not creating new value. They are bidding up the price of existing claims. The factory did not become more productive because a hedge fund bought its stock. The apartment did not become more useful because a private equity firm paid twice what it was worth 5 years ago. The price went up. The underlying thing stayed the same. But now, if you want to buy that stock or that apartment, you have to pay the new inflated price. The price that was set before you had access to any of the new money. The price that was set by people who were first in line. And this is the hidden tax. The one that does not appear on any government form. The one that is not voted on by any legislature. The Cantillon effect redistributes wealth not by taking money from some people and giving it to others directly. It does it by changing relative prices before most people even know the game has started.
Let us make this concrete. In 2020, the Federal Reserve and the U.S. government responded to the pandemic with the largest monetary and fiscal expansion in American history. The Fed's balance sheet doubled in a matter of months. Interest rates went to zero. Trillions in stimulus moved through the financial system. What happened to asset prices? The stock market, which crashed in February and March of 2020, recovered its losses by August, and then kept going. By the end of 2021, the S&P 500 was up roughly 115% from its pandemic low. Housing prices increased by over 30% nationally in under 2 years, the fastest appreciation in recorded American history. What happened to wages? They rose, eventually, after significant inflation had already eroded their real value. The median American worker saw nominal wage increases, but real wage decreases once you adjusted for the inflation that had been quietly building since all that new money started moving through the asset markets. The people who owned assets. Now here is the part that almost nobody talks about. The irony at the center of this entire story. The stated purpose of quantitative easing, of low interest rates, of expansionary monetary policy is to stimulate the economy, to create growth, to help people. The Federal Reserve has a mandate to maximize employment and stabilize prices. These are genuinely held goals. The people designing these policies are not twirling mustaches in dark rooms. And yet, the mechanism through which the policy operates structurally favors people who already have capital over people who do not. It is not a conspiracy. It is a design flaw so baked into the architecture that most economists treat it as an unfortunate side effect rather than a central feature. The money has to enter somewhere. It enters through the financial system because that is where the machinery exists to move it. And the financial system is owned by people who already have money. The policy meant to help everyone helps asset owners first, most, and most durably. And then, a report gets published 18 months later showing that inequality increased. And people are surprised, as if the outcome was not directly predictable from the mechanism.
But wait. There is another layer, because the Cantillon effect does not just operate through central banks and monetary policy. It operates through government spending, through venture capital, through the entire allocation of financial resources in a modern economy. Government contracts. Who gets them? Defense contractors, infrastructure firms, connected industries. The money enters the economy through specific companies, specific regions, specific sectors. Those companies pay their employees. Those employees spend locally. The wave moves outward. But the first beneficiaries are the contractors, the vendors, the industries with the relationships and the lobbying presence to be first in line when public money starts moving. Venture capital works the same way. When a new technology sector attracts enormous capital inflows, as happened with .com in the 90s, social media in the 2000s, and AI today, the money arrives at the top of the ecosystem first. Founders, early employees, early investors. The valuations inflate. The wealth concentrates. And then, if the technology does eventually create broad economic value, some of that trickles outward into wages and productivity gains for a much wider population. Years later, after the primary wealth event has already occurred. The pattern is consistent across contexts. New money, narrow entry point, early recipients benefit disproportionately. Late recipients get inflation.
So, what do you do with this information? Here is where most finance content would pivot into a 5-step wealth-building framework and tell you to open a brokerage account today. That is not what this is. Because the honest answer is complicated, and it has 2 parts. The first part is personal. If the Cantillon effect is real, and the evidence strongly suggests it is, then the most financially rational response is to own assets rather than just hold currency. Not because assets always go up, they do not, but because in a system where new money consistently enters through asset markets first, holding only cash means you are structurally last in line every single time the money printer runs. This is why financial advisors have been telling people to invest for decades, not purely because of growth or compound interest, but because staying in cash in a system designed to dilute cash is a slow, guaranteed loss. That part is uncomfortable because it means the advice that helps individuals also reinforces the system. You participate or you fall behind. There is not a clean third option. The second part is bigger, and it is the one that matters beyond any individual financial decision. The Cantillon effect is not a law of nature. It is a consequence of architecture, of choices about how money is created, where it enters the economy, and who has access to financial systems when new capital is being deployed. Different architectures produce different distributions. Some economists argue for direct monetary transfers to households rather than asset purchases, helicopter money in the literal sense, as a way of changing who is first in line. Others argue for targeted public investment in infrastructure and wages rather than financial asset inflation. Others point to broader asset ownership through sovereign wealth funds or public equity stakes as a partial structural fix. None of these ideas are simple to implement. All of them face significant political resistance from the people who currently benefit from being first in line. Which brings you to the actual uncomfortable conclusion. The system that decides who gets rich first is not hidden. It is not secret. The mechanism is well understood by anyone who studies monetary policy seriously. The people who design the policy understand the distributional consequences. The people who benefit from the policy have every incentive to keep it running. And the people at the end of the line, the ones who get the inflated prices and the diluted currency, rarely have the language to describe exactly what is happening to them. They know something feels wrong. They know prices are rising faster than wages. They know people with assets seem to always come out ahead. But without the framework, without the name, without the mechanism spelled out clearly, that feeling stays a feeling, a vague sense of unfairness that gets channeled into politics or resentment or resignation, rather than into a precise demand for structural change.
Cantillon died in 1734. His insight has been sitting in economics textbooks, mostly unread, for nearly 300 years. And the system he described has been running mostly uninterrupted ever since.
The question is not whether you understand it now. The question is what you think should be done about it, and whether anyone with the power to change the architecture has any real incentive to do so. So far, the answer to that question has been consistent, and the line stays exactly where it is.